Very good afternoon to you, traders. Hope this finds you well. Presenting from a very wet and cold London. My name's Rob Colville, head of thelazytrader.com, and today we're going to talk about how to profitably trade moving averages. And I really want to, in this presentation, not only teach you how you can profitably trade moving averages, but also dispel quite a few popular myths, which certainly I find when I'm mentoring people seem to be firmly ingrained in the mindset of the amateur. So not only do I want you to learn how to trade them profitably, but I also want you to learn how to use them in the correct way, because there's a lot of people using moving averages in completely the wrong way. And we want to keep life simple for ourselves and as high probability as possible and as clear. So without further ado, I'm just going to tell you very briefly about who I am and what I do, and then we'll start the webinar. I've taught people from all walks of life how to trade financial markets, head of thelazytrader.com, which is a London-based online trading academy. And 6-7 years ago, I was a rookie, just like a percentage of people in this room, and I've admittedly made every single mistake in the book several times over, but it's through doing this I've managed to find my edge, which has worked very well in the market since, and certainly moving averages and applying them in the correct way is part of this edge. So let's talk moving averages. Without further ado, just quickly read the disclaimer. This is for educational purposes only. But before we start the webinar in earnest, I just want you to make a note of this. This single word, December 888, Chinese lucky number 8. The reason being, you'll find out later on after this webinar, this word alone could potentially help your trading long term. Okay, so make a note of it. I'm not kidding. To the webinar. So today, I'll talk it in terms of using moving averages successfully and effortlessly, should I say, as well. Firstly, we want to find a moving average combination that suits you. Sure enough, there are loads of moving average combinations out there, as many combinations of moving averages as there are combinations of on a lock, for example. There are thousands, hundreds of thousands. Some work some of the time, some work most of the time, but no moving average combination works all the time. So it's very important that you get that, essentially, and together we'll choose a combination which suits us. Secondly, we'll look at what we call order, angle, and separation, so the positioning of the moving averages, which is very important to their success. Then we'll look at whether price has tested it before, and then we'll see if we've got an opportunity to trade it. Okay, so let's move on. We're going to do a lot of chart-based work today, because I think it's very important that you see this in real time rather than just me digging out an example from the past and showing you picture perfect hindsight trading examples like a lot of people do. I just want to apply all of our learning to the present and current market conditions, but I think it's very important that you get a real-time education of financial markets trading. Okay, so we'll look at a few past examples and we'll build up a watch list together. Hint, hint, all the currency pairs which I'm watching for moving average-based trades are right here. So make a note of them. So without further ado, let's go to the charts. Okay, so remember what I said just now about order, angle, and separation? Well, I'll talk to you about that after I talk to you about why I've chosen this moving average combination. I usually go for a long-term moving average, a medium-term moving average, and a short-term moving average. So I trade using 3, the 200 exponential moving average, the 50, and the 20. So I've got a long-term, a medium-term, and a short-term. Moving averages only work in trending markets. And what they really allow us to do when we're doing our analysis is to objectively get a perspective of whether the market's trending. All right, so there's no good using moving averages if the market is ranging sideways. I'll show you some examples a little bit later on about that. Okay, but in this case here, we've got pound versus the Swiss franc, and we can objectively, even if we're not looking at price action on its own, even if we take price action away, we can simply say, just look at moving averages, that this market is trending because we've got what I just mentioned, order, angle, and separation. So we've got the order of the moving averages in the right way. So we've got the 200 to begin with. Underneath it, we've got the 50 moving average, and then we've got the 20 below it. These are exponential moving averages, not simple. I'll talk to you about why I choose exponential moving averages in a second. But for this reason, it shows us objectively that we've got longer term bars and sellers, obviously bearish. The medium term bars and sellers are got a bias on the sell, and the shorter term bars and sellers, the sellers are in control. So it really just gives us that very objective measure as to whether a market is trending downwards. So we can see alone with the order of these moving averages that it's trending downwards without even looking at the price action, even though I can't really get rid of the price action. So we've talked about the order. If we're in a downward trend, we want the longest term moving average to be at the top, the medium term moving average to be in the middle, and the shortest moving average to be at the bottom. So that's the order. Now we'll talk about the angle. So remember what I said about order, angle, and separation. We have a nice sloping angle here for the 200 and the 50 and the 20. The angle basically gives us the heads up that we've got movement. Like this price action is moving downwards, so of course the moving averages are going to be following it. Even though there's a lag, it will be following it. Of course, if the price action is moving sideways, then the moving averages will be flat, facing to the equivalent of 3 p.m. if you imagine the clock face. But we want our moving averages to be, if you imagine this clock face, tilted in their angle between 4 and 6 p.m. here. So we've got order, we've got angle. Let's talk about separation now. And when I talk about separation, it's also just a confirmation that we've actually got the market doing something, in this case, moving downwards. So separation means that we've got distance between the moving averages. Like we've got a good wide distance between the 50 and the 200, and we've got a good distance between the 50 and the 20 as well. So we've got order, angle, and separation. So we go back to our checklist, and I'll just quickly show you what else we need to go to. So we've got order, angle, and separation. Now we want to see what price is doing. Has it tested it before? Well, let's have a look here. I can definitely tell you one thing about price here, and this is thanks to the analysis of the moving averages. It's moving downwards. But here, in the very much the same way as horizontal levels of support and resistance influence or have an influence over the direction of price, seemingly so too do moving averages. And the great thing about moving averages is that they can behave like dynamic levels of support and resistance. What do I mean by dynamic? Well, you've probably guessed it. Dynamic in that they're moving. And this happens certainly when we've got trending markets. And the great thing about moving averages is they can give us a very objective measure as to whether we've got a level of resistance in a dynamic way. The problem with horizontal levels sometimes and trend lines is that they are objective. Whereas if we've got a moving average already plotted on our chart for us as a result of a mathematical equation or sum, then we've got objectivity. And certainly when we're in the market, which is propelled by emotions, it's very important we keep our head cool. So this is why I find moving average trading extremely refreshing. So here we've got the first test of this 20 moving average, that it's tested as resistance. It's actually touched the moving average, and then it's gone down. Fantastic. We already know the price action is moving down. No prizes for guessing that. So then we get a pullback. And, of course, we've got the market making lower highs and lower lows. And in that it's cycling. Let me make this bigger for you. So we've got a second test of this moving average. Unlike levels of support and resistance, all we need in our dynamic level of support or resistance in terms of moving average is one prior test. We don't need 2 prior tests or 3 prior tests like we would a horizontal level or a trend line. All we need is one prior test. So we've already got it here. So we are on alert now for our potential trade opportunity, as we've already seen before here, that this 20 EMA has actually behaved like a dynamic level of resistance. So we've got price action come to this 20 moving average, but that's still not enough. We want a signal to get into the trade, like a price action based signal. It could be a moving average. It could be, a a bearish pin bar reversal. It could be a doji. It could be a double inside bar, but we tend to go with bearish pin bar reversals because it's a sign that the bulls have tried to come into the market but have been completely trounced by the bears. So, lo and behold, we have a bearish pin bar reversal. And the great thing about this is not only has it respected the 20 moving average, it's also got a correlation of reasons why it looks so great, because it also, old support here is becoming resistance here. So what we could typically do in this instance is place our orders just like vanilla trading bullish pin bar reversals. In this case, a bearish pin bar reversal. So just place our order just below the low of this bar, minus spread, minus the extra pip, with our stop loss above the high, plus spread, plus that additional pip, and wait for the low to be broken. We could target the previous swing low as our first target, take profit 1, and a lower low as take profit 2 for our low probability, high reward outcome. So there we go. It takes a while. There we hit profit, take profit 1, and then take profit 2. We see we're cycling quite nicely. There we've got our phase 1 extension leg here. Then we've got phase 2, the retracements. Of course, markets never go up or down on a straight line. They breathe in and breathe out, just like an organism. Well, not an organism, a mammal, an animal. Nothing ever goes up or down on a straight line, unfortunately. People who've been in a long-term trade will be able to tell you. But that's fine. Absolutely fine, because it means that we can take advantage of key swings multiple times. So what happens next? Well, we know full well at this time that this 20 moving average is a level of dynamic resistance. We've got test 1 and test 2, and now we've made a new lower low here. We've got lower highs and lower lows. We're just waiting for a retracement and then a pin bar reversal off it potentially. Okay, we don't have it, so we are still on alert. There we have it. That's our bearish pin bar reversal. And once again, we've got it not only below this 20 moving average, it marks as a decent entry point to potentially go short, because it's intersecting with the previous swing low, for example. And that's a good entry signal. So then typically what we do in terms of trading it as vanilla price action is to place our entry just below the low here, stop loss above the high, and then our target for a higher probability lower reward outcome is the previous swing low. And then if we wanted to go for slightly higher profit potential, but accept a slightly lower probability, is we go for a new low. And the purpose of this webinar is not for trade targeting, but certainly it's for moving averages. But just to give you an idea as to how we typically target in a trending market. So you can see here that we can use moving averages as not only dynamic levels of support and resistance to validate a trade in a trending market, they're also used to validate a trending market before we've even got to the trading opportunity. So on one hand, they're used for our to help us in our entry signal for a trade long or short, but also to gauge a perspective of the market. So we get triggered into that trade, beautiful kind of move downwards, and then very nice move downwards. I remember I didn't catch the whole move, unfortunately, back then, but decently to get to the previous swing low, plus a little bit more. Not all the way down there, but hey, sometimes it's damned if you do, damned if you don't. So there we go. As you can imagine, I was quite gutted I didn't get the move all the way down. But as I said, it's damned if you do, damned if you don't. And at the time when we had this move upwards, an extreme retracement, and we had this bearish pin bar reversal above this 20 moving average, then that disqualifies this 20 moving average as a dynamic level of resistance, unfortunately. So at the point where we get a close above the moving average and the next bar takes up the high, then this disqualifies the 20 moving average. And then at that point, we just need to find the whole process. We have to wait for the whole process to repeat itself, essentially. So we need to wait for the market to come down again. Not as it does. We need to wait for the market to come down again and test it once as a dynamic level of resistance for the order of the moving averages, and eventually make a new low before we can use it as a dynamic level of resistance again. Okay, so that's an example of a downward trending market and how we can essentially use the 20, 50, and 200 moving average to analyze the market as well as to trade off it. Let's talk about a slightly more recent example here. I want to look at the dollar versus the Norwegian krona here. And I would like to just say something on a side note here, that a lot of people, for some reason, they just shy away from these Scandinavian cross pairs, not just cross pairs, but just with dollar-based Scandinavian pairs as well, because I'm not sure why exactly, but they just ebb and flow and move like any other currency out there. And we have had some fantastic moves of the Scandinavian pairs. Not necessarily to do a spread at all. I mean, you'll find that the spread might look like a huge reason why not to enter, but if you look at the spread in comparison to your potential reward, you'll find that it's all relative, actually, to if you're trading like an exotic cross. But anyway, we'll talk about that a little bit later towards the end of the webinar. If you've got specific questions on this. So if we look at the dollar versus Norwegian krona, we have, you probably guessed it, we've got order, angle, and separation. We've got the 200 moving average, the 50, and the 20, like so. So we've got the order. That's great. It objectively tells us that we've got an upward trending market. And certainly if we've got price action above the 20, then we've got good speed and momentum in the market. This is on the daily time frame, by the way. And I only trade the daily time frame or the weekly time frame for my own sanity. The prospect of watching charts all day really doesn't excite me that much. So if I can just get as much profit potential from the market from doing the minimum amount of work possible, then I'm happy. I really have no interest in watching moving lines, charts and indicators, flashing lights, broker signals, emails from brokers, recommendations, speculation all day. It's life's complicated enough, right? Anyway, back to moving averages. So as we say here, we've got order, angle and separation. Got the 20 above the 50, the 50 above the 200. And we have separation between them. And of course, we've got the angle. The angle is important. If it's facing upwards, the angle, then it's a sign that the market is trending objectively, even if we took away the price action. So here we had the first test on this 20 moving average all the way back in September. That validated it as a decent, well, essentially as a level of dynamic support. And then we had a higher height. Then we had this bullish pin bar reversal back in October. Let me just do this in real time. Sorry. It's a lot easier for you to see if I just go back and simulate it. Bit late now, you're probably thinking. So here we've got the test that it's a level of dynamic support. It's a higher high. Then we've got a potential signal bar to go long. It's, lo and behold, a bullish pin bar reversal, just about more of a hammer actually looking at it. And it's tested this 20 once again as a dynamic level of support. Remember what I was saying, unlike horizontal levels where we require at least 2, 3, preferably tests on it to validate it as a level of support or resistance, we've got only the requirement for one test when it comes to moving averages, as long as you've got the right order, angle and separation. So we've got our signal. Typically, you can place the entry above the high, stop loss below the low, and get triggered in. If you wanted to be slightly more aggressive, then you could put your order halfway down the bar with your stop loss below the low. I know some people do that, although I'd rather do that in an instance where we've got a false breakout, and we'll talk about that another time, false breakouts, because it's not in the scope of this webinar, but there's some very good strategies in how to trade false breakouts. So here we go, move upwards. We've already taken profit at the higher high potentially and started to scale out on the move upwards. And there we're just simply waiting for another opportunity for a long. And when price action did come back to this 20 moving average with the dollar versus the Norwegian krona, guess what I was waiting for? I was waiting for an excuse to get into this trade. We had the extension, we had the pullback. Now I'm just simply waiting for a lovely small activated bar in the form of potentially a bullish pin bar reversal with, you can see here we've got consolidation and choppiness here. So I was waiting just specifically for a bullish pin bar reversal with the tail just below this choppy zone here, this choppy box. and to fire long, but did I get it? No, I didn't. So unfortunately, my dastardly plan was thwarted here. Instead, I just sat back and watched it make a new high, and that it has. But it's all good. We'll wait for it to come back again, and if we've got price action coming back, not only to this 20 moving average, which has been tested 1, 2, 3 times previously, if it comes to intersect with this previous swing high here, then fantastic. We have a confluence of reasons. We have more than one reason to get long in this case. Christmas market, some of you are understandably a little bit nervous about trading around about Christmas time. A lot of you kind of ask, oh, do I trade on the day before Christmas Eve, New Year's Day, the day after New Year's Day? Well, to be honest with you, if it's a weekday, I do it regardless. I mean, markets might be thin, but we do get some good moves over Christmas time. I wouldn't trade on Christmas Day or Boxing Day, but certainly around Christmas and the lead up to it, certainly I would. And if you back test, if any of you do that, you'll see that actually you do get some very good moves over Christmas, even though logically there wouldn't seem to be any reason for that to be the case, but you actually really do. And a lot of people kind of say, okay, so do you worry about news when it comes to trading these moves as well? The answer to that is no, I don't. Because on one hand, if you're going for positive reward to risk, say, for example, you've got like a reward to risk potential of, say, a 3-to-1. Well, if you think about it logically, if the news announcement is in your favor, 50-50 being in your favor or not, if it's in your favor, then it could help perpetuate a winning trade, make you winning 3%, providing you're risking 1%. Or it could lose you whatever you've risked, 1%. Okay, so if you imagine flipping a coin where you know that if in the 50-50 chance you're right, you make, say, £300, and if you're wrong, you only lose 100, then you're going to keep on flipping that coin, to be honest with you. If you've got a decent technical reason to back up your trade, and it's with the trend, certainly when it comes to trading with moving averages, then I would enthusiastically just to trade regardless of news, provided you've got decent reward to risk. If anyone's backtesting, for example, a system or strategy, certainly when it comes to swing trading, honestly, news and what was released in terms of data on that day and how it affected that market is not factored into any scientific backtesting results. It's all about were the entry conditions met on the chart purely from technical perspective. So that's it, really. That's why I don't care about news. I like to keep my life as simple as possible. And the moment when, certainly speaking from my own experience, the moment you start trying to second guess the news or speculating what the Bank of England, the Bank of Japan, the Federal Reserve are going to do, then quite literally it's opening a can of worms. And it really doesn't make trading what it should be. Trading really should be a peaceful, easy and effortless pursuit, which you just happen to do in the background, and you're making a good return from it rather than it dominating your life and be all consuming, because it really shouldn't be like that. And if it wasn't like this for me, if I couldn't tailor trading to be a lifestyle choice for me, then quite literally I wouldn't bother doing it. But the fact is it's this is the way it goes, and it can be tailored that way to suit your needs. And I can speak from my own sore experience, because when I was new to this, when I first graduated and went up to London to do a Dick Whittington and seek my fortune, I opened up the spread betting account, and you know what, I gambled, and I guess you do learn the hard way, or you could learn the easy way. And it's great that you've all come to this webinar, because I don't want you to make the same kind of mistakes as I did back in the day. Because I did, make quite a few mistakes, and I can openly admit to you. I'm not going to say to you that trading came easily to me, but I've managed to find a way of trading which is extremely easy for me to implement into my daily routine, and there's no reason why you can't do the same. Anyway, let's talk about moving averages. I think that rant's over. So let's apply moving average theory here to the markets, what's happening now. Okay, so I just want to talk to you about kind of markets which we don't really want to apply our moving average trade opportunities to, and these are generally ranging markets. And how do we guess what ranging markets are? Well, let me try and find a ranging market now. It says it's like, for example, here, when you've got the moving averages just moving sideways here, if you imagine a clock face and we've got 3 o'clock here towards the side, and we've got the moving averages just facing towards it. That is an objective sign of a ranging market. And for that reason, we've got no real order. You've got the 50 here, the 20 between the 50 and the 200. They're moving sideways. This is a pretty damn awful looking market. British pound, New Zealand dollar. It would be a great market if you're a range trader, if you were to simply have your levels in advance and you're just speculating a move or a reversal trade off these levels. But quite frankly, in terms of a trend-based opportunity, like this level here, absolutely fantastic level, around about 2.100. This could be a potential level to simply have an order to sell off and just walk away, but this wouldn't be a moving average based trade. It will just simply be an opportunity to move on to the next one, basically. And let me talk to you about pound and NOK. I traded this one last week, and my clients did as well. We made a decent gain from this, and this was thanks to a trade-based opportunity on the weekly time frame. There we are. So let's move back. We've got, lo and behold, this is why, the Scandinavian cross pairs are great, because they just, as you can see right before your very eyes, they just ebb and flow in exactly the same way as any other currency. Just because it's a Scandinavian and it's a weird pairing, not as common as euro dollar or dollar yen or cable, it doesn't mean it doesn't behave or can't behave in the same way. Okay, so you can see here that we had great opportunities in the past. We can see here that even though we've got order, i.e. the 20 is above the 50 is above the 200. We've got the angle, it's moving upwards, got the separation. So here, we had a pullback last week. It wasn't off the moving average, unfortunately, so we can't really class this as a moving average trade, but we did have other reasons to validate it as an opportunity for long, and this was the fact we know it's a trending market, we know we've just had a pullback, we know it's trending upwards, we know the moving averages are in the right order, they've got angle and they've got separation between them. We just don't have the moving average the price action bullish pin bar reversal testing the moving average. So we traded this one just using the moving average theory to support the trade. It wasn't off a level of dynamic support, i.e. the moving average. Instead, it was just off the previous swing high, which validated this as a technical trade long. And sure enough, it just fired long the next day. Great. And we got out of it on Friday, made about 3%, about 2.5%, let's just say that to be conservative. And just walked away. It was a simple, quick fire, easy gain trade, which we just got in and out of, no real kind of effort spared. And there are trend-based opportunities like this. The great thing about this moving average theory is you can apply it to any market. It doesn't have to be currencies. Wink, wink. You can do it to stocks, precious metals, commodities, stocks of any kind of from any country, whether it's the Dow or the S&P or NASDAQ, whether it's the DAX, the CAC. The list goes on, really. Price action is universal, and if it wasn't, then I wouldn't bother with it, quite frankly. This is the great thing about this kind of way of looking at the markets and the strategies. You can see that price action and the psychology which drives the price action is firmly ingrained into the psyche of the markets, and it has been ever since tulip mania within the 1700s, and that kind of epoch in Netherlands when people were the value of tulip bulbs was just going through the roof. And if you look at any kind of Japanese candlestick chart reflecting that period back then you'll see exactly what I mean. Trends, higher highs and higher lows, levels of support and resistance. It behaves in exactly the same way as it does nowadays. So people have got short memories, and it's interesting actually when we look at certainly the FTSE or anything like that. We talk about short memories. We've got this horizontal level, this penultimate all-time high here, and stocks are massively overvalued at the moment, and the Warren Buffett indicator is flashing. So if we look at the moving averages in accordance or apply it to the FTSE, we can see here that they're moving sideways. They're in a bit of a pickle. So there's not really an opportunity to kind of trade this based on moving averages. It's not really trending upwards. In fact, the FTSE is moving sideways. Whilst the FTSE is moving sideways, and we've got the Dow breaking to new highs, here, just look at it, massively over bloated. It's yeah, wow. Need I say any more? A pullback may be due, but then people are talking about a pullback, um, speculating about a pullback around about here, but it's overshot the top of the trendline resistance. There we go. Can it go any higher? Well, we've got the Santa Claus rally to be had. We'll see. Maybe it'll be a very small rally, the Santa Claus rally this year, because things are so overly bloated. But when you see that the Dow's so massively extended and the FTSE is still fumbling sideways, this does give us an interesting indicator that if the Dow is going to fall and we're going to have a rather kind of seismic January effect, the January hangover, which typically exemplifies the rest of the year. January is always a very good indicator for how the rest of the year is going to be going, apart from this year. January didn't really tell us much about this year. But we can see that if the Dow falls, then the FTSE is probably going to fall down a lot faster because we're not breaking to new highs. We're just moving sideways, okay? So let's go back to some more examples. I'm just going to bring up the PowerPoint presentation again because we've got we've got point 4, just to the point raised in the questions box. Do we have a price action based sale was my point 4, and we always look for that whenever we look for an opportunity to trade off, specifically a moving average. Okay. In terms of a watch list, well, we've got quite a few actually, which we're watching at the moment, and these are simply currency pairs which we have order, angle, and separation. We've got trending price action, and we've got the market's trending upwards or downwards, and we're just waiting for price action to come to the moving averages essentially. So let's take a quick look at this. Let's start off with the British pound, cable, fondly known as. Let's get a longer term perspective here. It's going to take you to another chart. If I still have it, I might have accidentally deleted it in my excitement earlier. There we are. So here we've got cable, which is just ranging really, long-term range, trending downwards. We've got a trend inside the range essentially. I mean, look at it here. This is the weekly time frame, and we can reasonably expect cable to come down to either this level here, this level here, this level, or this level. There are about 4 levels in the way of it reaching its multi-year low, last reached at the credit crunch in 2009. But until then, we've got a wonderful trend here on the daily. You can see it's happening on the weekly, bit of a lag on the weekly, but we've got the 20 crossing over the 200 and the 50 just lagging behind it on the weekly. But on the daily, we've got order, angle, and separation. We've got the 50 below the 200, we've got the 20 below the 50. And we are making rather jagged. It's not great cyclicity, by the way, but it is a step in the right direction. We've got lower highs and lower lows here. And what we're simply waiting to happen for cable is for a decisive lower low, for price action to pull back, and us to get a reversal bar off a moving average. And that's all what we're waiting for. So we've got this level of short-term support here. What we're waiting for now, as we've just been in this choppy mess for a while, we're just waiting for a break out of this, price action to make a new low, come back, test what would be hopefully the 20 moving average by the time price comes back after making a new low, an intersection between that and this horizontal level here. But we just need to wait patiently for that. I mean, this could happen in days, it could happen in weeks. So no real time frame from it. It's really very much the same kind of story for the Aussie dollar as well. We've got here great order, angle, and separation. We've got the 20 below the 50 below the 200. We haven't actually got any evidence that it's tested the 20 moving average before, so we just need to wait for it to at least test it once and then make a new low, come back again, and then test it for a second time, and then we've got our trade opportunity. But the Aussie dollar does look like it just wants to go down, and that's it, the end. And same with the Kiwi dollar. The Kiwi dollar does just very much like gold and silver. It just follows the Aussie dollar, and we're just waiting for. We've got our order, angle, and separation. We've got the 50 below the 200. We've got the 20 below the 50. We're just waiting for a decisive new low to be made before we are able to take advantage of a retracement to a moving average, then a new low, then a retracement again after the validation of the moving average. Okay, so let's go on to uptrending markets now, and I don't think you have to have really dug deeply into the markets to have come to the conclusion that we've got major yen weakness and dollar strength. So we've got this this chart here, which seemingly knows no bounds. So all we're waiting for is a pullback. Are we going to get it? Well, it's been very conservative in the pulling back, I have to say. We've got great order angular separation here. 20 above the 50, 50 above the 200, and but we just want evidence that is testing the 20 moving average as a dynamic level of support. So you want a retracement back to the 20 before a higher high and a higher low is made, and the second test is our opportunity to potentially trade this one long. So that's the dollar yen, dollar Singapore, same story really. We've got higher highs and higher lows here. We've got great order angular separation, and we're just waiting for a pullback to this 20 moving average, and we could trade it for a continuation if only we had evidence that it tested this level before, and we could treat this one here, this opportunity here, not opportunity, sorry, this touch and test of the 20 as a previous test of the moving average, like so. There we are. So moving on to dollar CAD. It doesn't always have to be the 20, by the way. In this case, it could be the 50 moving average, and we've seen it testing the 50 moving average 1, 2, 3, 4 times. So lo and behold, I'm waiting for it to come back to test the 50 again. If I get an opportunity to go long off the 50, I will take it if I wasn't so cautious about a potential phase 2 retracement in this trending market upwards. And that's my only concern. It does look like it's trying to top out here. But this is why we're quite specific in us waiting for a price action based reversal to the upside if ever we get a continuation to the upside or downside, because we want to obviously filter out trades which are slightly lesser in probability. Okay, so one more trade example which is on the watch list is EuroCAD. And here, once again, we've got an opportunity, an example of where we've got testing of the 50 moving average here. Got 1, 2 tests of the 50 moving average. You've got order angular separation, the 200's above the 50, 50 is above the 20, and we've just got here. Is it interesting twin tower setup bars? It's interesting. These are what one of our key traders on our service, Julian, refers to as ring highs, where we've got the opportunity to sell here, and I believe some of our clients who do trade this strategy would be in this one, this trading opportunity here. It's respecting the 50, not the 20, but we still got order, angle, and separation there. Okay, so just to recap, so we've got our watch list, which is bulging full of potential opportunities forthcoming, so it's up to you to really watch the market. So we've got cable, Aussie dollar, Kiwi dollar, dollar yen, dollar Singapore, dollar CAD, and Euro CAD. Well, I just talked to you about Euro Oz. My mistake. Let's have a look. EuroCAD does look good too, by the way. Oh yeah, it was EuroCAD. Sorry, I'm going mad. Obviously, I was at the gym at 6 a.m. today, so that's what's doing it. So that really concludes moving averages. I'm going to go through your questions now. So you've got 5 minutes left until the end, but I just want to thank you all for coming today and tuning into this webinar. I will say that I know how difficult trading can be, certainly if you're starting out. You don't know where to start, but this is why I'm always very happy to help other people, especially as I only trade really from only about 10 minutes a day. So it leaves me a lot of free time to do lots of other things, including mentor people. So what I'm doing, especially for people who've come to the webinar today, is offer our flagship service called Ultimate, which will teach you how to trade any asset class, any market from as little as 10 minutes a day. You get access to everything. It's valued at $1,997. It can give you access for only $97, so a huge discount, but it's only available until midnight tonight. So to get this discount, the coupon code, promo code is December 888. Okay, so within the membership, you'll get access to trade ideas, weekly webinars, access to people, a knowledge base of over 25, 40 years trading, and access to all of our strategies, all past webinars, trader hypnosis audio course, free indicator software, and certainly a full refund if you're not completely happy. One thing I'll do as well is I'll give you a free one-on-one mentoring session 31 days after you come on board in January in the new year. Okay, so it's only available for today. If you want to get this discount, save yourself over $1,800, then get on board. But it's only available tonight. Okay, we'll be pulling this offer 1 o'clock this morning GMT. So hopefully see you the other side. As I said, you've got nothing to lose. Full refund if you're not 100% happy. But seriously, it's quite good value, and we haven't had any complaints so far. Touch wood. And yeah, I look forward to welcoming you to our community. So I'll leave this on the screen. In terms of your questions, let me go through some of your questions. Quite a few questions here. Okay, so FX Boyke, no indicators really for this trend, these trend continuations. No, I let the moving averages speak for themselves, quite frankly. The fact that we're looking for order angular separation and a trending market and a price action entry into the market is certainly sufficient. Okay, so I don't use anything like stochastic or RSI. Certainly, it's a bonus if you've got hidden divergence or anything like that, but I'm not really a fan of indicators, if you want my honest opinion. Okay, so I've got one from Chris Hondros, sorry. Can I ask you? I'm not really sure what you mean there, mate. Let's have a look. I keep trades open over the weekend, absolutely. I do, because I trade the weekly and the daily charts, so I always like to keep my trades open for as long as possible. Because they might just be on their way to profit. If I close my trades before the weekend, I might miss out on all this wonderful upside, and when that's the case, I'll regret it. And I like to just sit in trades and forget about them, whether they're in the market for weeks, months. I'm in the market and I'm happily taking advantage. The question, why 50 and 200? Because they're the ones that work best for me. Okay, they are standard generic moving averages, 50, 220, but they work best for me. Some people use slight deviations to them, but tell you what, some people use Fibonacci-based moving averages. That's absolutely fine. If you want to do that, then be my guest. But as I said to you, some moving averages work some of the time in some markets, some work most of the time in most markets, but no moving average combination works in every market the whole time. That's the thing, just like strategies, really. I believe this was recorded. Yes, that's right. What triggers your trades? I place up orders to my broker, and I wait for them the market to come to me, essentially. And that's what I do. I don't like to get into the market live. I don't want to be in front of the screen placing my trade, because that ties me to a desk at a certain time. I just want to set up my trades and just walk away, go to the gym, go and cause mischief in London, see my friends, go for coffee, travel, all that good stuff, really. I don't like to be tied to the markets and the flashing lights and hypnotic effect of the broker platform. So I'd always encourage you to look at the higher time frames, because they really are a peaceful way of trading, and it's a huge misconception that they're not as profitable as the shorter term time frames. A lot of people seem to think that because you're making more trades and in the market all the time you're making more money. That's a complete lie and a complete misconception. Okay, so if you've not got any more questions, then I will wish you the very best. Happy trading. If you've got any questions, do drop me an email at rob@thelazytrader.com, and I'll happily answer them for you. Okay? Happy trading to you all, folks. Wish you well.